Hey, I hope you and your families are doing well. In this video, I'm going to teach you what I think is the best way to improve your swing trading. To do that, I'm going to teach you 3 variations of Japanese candlesticks that I call gap down reversal bars, shakeout demand tails, and trigger bars. I'm then going to teach you 3 simple swing trading setups using variations of these Japanese candlesticks. And then I'm going to teach you how you can practice in a very deliberate manner using the TradingView bar by bar replay function to improve your trading skill set in how you identify trades, how you control the risk, how you mitigate the risk, and the selling rules and selling guidelines that you use to optimize the profits. To do that, I'll take you through 3 of my recent trades, 1 in RTX, 1 in HMY, and 1 in LYFT. So I really hope you guys are going to enjoy this video. MarketSurge are today's video sponsor. They are the platform that I use to conduct fundamental research. If you're interested in a discounted trial, then you will find a link in the description and the comment section below. Okay, so part 1 of this video is going to involve some pattern recognition. So we're going to be looking at Japanese candlesticks, and I'm going to teach you about 3 variations, which are going to be gap down reversal bars, shakeout demand tails, and trigger bars. So let's start with the gap down reversal. Now this is made up of 5 main variations of common Japanese candlesticks, which are known as a piercing pattern, a belt hold bullish, a meeting lines bullish, a thrusting pattern, and also a bullish engulfing candlestick. You may have heard of some of this terminology before, such as a bullish engulfing candlestick. Now what's important is we have a lot of data here. So the data that you can see, say for a belt hold bullish, in Thomas Wasolski's book, The Encyclopedia of Candlestick Charts, it's over 900 pages. He tested 4.7 million Japanese candlestick combinations. That is the most thorough study of Japanese candlesticks that I know of. So in his book, there are 14,542 database inputs for the belt hold bullish. In a bull market, the reversal rate is 71%, and in a bear market, the reversal rate is 71%. The frequency rank is high of 22 out of 103, and the performance rank is around about average 62 out of 103. Now that's important to know, but what we're going to do is we're going to think, when we get into the second part of this video and we start going bar by bar and I teach you how to practice these type of setups very deliberately, it's not just what you see in terms of the candlesticks, so the belt hold bullish or the bullish engulfing candlestick. It's not just what you see, it's the context of where do you see it. Okay, so it's not just what you see. I see a belt hold bullish, I see a bullish engulfing candlestick. Great, but where do you see it? So is it at the 21-day EMA? Is it the 50-day? Is there a perfect flag or a wedge or a pennant or a Davis box building as well? So it's the context. But if we just go through the psychology of why a belt hold bullish has a very high reversal rate, I'm just trying to find my pointer. Where's my pointer gone? There it is. Okay, there we go. Live videos and all that, right? So there we go. So here's the closing price. Now imagine that this is a daily candlestick. So the prior close is here. Now what happens is the stock gaps down and it opens here. Now, what do you notice? The open is the lower the bar, and you're going to see this on HMY, one of my trades, when we go bar by bar a little bit later. So if you think about this, the prior closing price is here. The stock comes down, it gaps down, and the open is the low of the bar. So the open is the low of the bar, so it gaps down. Now imagine that this is just below the 21-day EMA, or maybe it's the 50-day, and there's a really nice developing flag or wedge or pennant or Davis box, and the stock's showing a lot of relative strength, and then you get this bar. What's that telling you about the presence of demand? It's immediate. As soon as the market opens for this stock, buyers step up immediately and start pushing it higher. And then it's a nice strong candlestick with the close being up here. So now you're starting to understand the psychology a little bit behind these type of candlesticks. So it's not just what is going on from a supply and demand perspective, where is it happening in the context of the chart and how the base is developing and the relative strength that the stock is showing. So this ain't going to just be a fluffy video. I really want to try and give you some information here, some high level detail, and then I'm going to take you through a little bit later how you actually then apply this for identify, control, mitigate, and optimize. So these are what I call gap down reversal bars. Now let me take you on to the next slide. Let's delete all of that ink and let's go on to the next slide. So this is going to be shakeout demand tails. So shakeout demand tails, the main Japanese candlesticks are going to be hammer candlesticks. You've probably heard that terminology before. Doji dragonflies and also Takuri lines. So these are the main Japanese candlesticks, which for me make up what I call a shakeout demand tail. Why? Because it is shaking out weak hands. Now again, it's not just what happens, it's where does it happen. So you can have a hammer type candlestick, okay, that opens here opens here, goes down, let's say it goes below the 21-day EMA and then recovers and closes very strong, and maybe it undercuts the last 2 weeks of price action and the volume is really low. What does that tell you about supply and demand? It could tell you that there's not that much supply, there's not that much selling. And then we have 20,000 database inputs, which is where Thomas Versolsi did the cutoff for them. The bull market reversal rate 60%, the bear market reversal rate 59%. We can see the frequency rank, the performance rank, a little bit more extra detail. We can see with a Takuri line as well, which is basically longer than a hammer candlestick. Imagine here, you get the open here. Imagine if it goes down, puts in a big shakeout underneath, say the 50-day moving average, and then you get this really strong close. I should draw that high, shouldn't I? There you go. Gets this really strong close up here. Well, what do we see here? We can see the bull market reversal rate 66%, bear market reversal rate 63%. So trading is a game of probabilities, it's not certainties, and we're trying to stack things in our favor. Okay, we see a Takuri line, but where do we see it? On what type of stock do we see it? Is the group, is the theme showing a lot of relative strength? Is it happening on a key moving averages, the 10-day, the 21-day, the 50? Is there a nice clustering of them? What happens on the volume? Does it undercut the last 2 weeks, 3 weeks of lows, knocking out a load of stop losses, get rid of those weak hands? So it's not just what happens, it's where does it happen? So these type of candlesticks, really, really important to be dialing in terms of the pattern recognition. And then the final one is what I call variations of trigger bars. So these are going to be trigger bars. So there's no real kind of database input for these in terms of Thomas Versolsi's work. Toby Krabel did a very detailed study on this. You can find a copy in his book on Amazon for like 1,600 quid or something like that, or I've got a YouTube video, search on it somewhere on the channel, you'll be able to find it. So trigger bars are oftentimes tight, low volume inside bars sitting around one or more key moving averages, but they don't have to be an inside bar. If you want a more detailed description, then you can pause the video and read this, or read it while I am talking to you. But what I'm looking for is inside bars that are really tight. They don't have to be an inside bar, but oftentimes they are just a really tight bar sitting around one or more key moving average, preferably on really low volume, just to indicate there's not that much supply coming through. But what it could be is, let's say example number 4, right? This could be a gap down reversal bar. Okay, I don't know why that O's there. Don't know why that O is there. Okay, let's move that. So what it could be is the stock gaps down. So the stock gaps down to say the 21-day EMA. So the O should be down there. There we go. So the stock gaps down to the 21-day EMA, and then it pushes up, closes really strong like this. So let's say we get the 21-day EMA doing something like this, and then you get another gap down reversal bar. So let's say that the open is here, the close is here. So the price gaps down off the open, it gaps down, it opens down here, pushes up, closes strong, and then you get this really tight inside bar just sitting just above the 21, and maybe the 10 is there as well. So again, it's trying to understand things from a supply and demand perspective as well, and the context of where it's happening in a developing base. So where things happen are going to be really, really important. So what we're going to do now is I'm going to take you across to TradingView, and we're going to go bar by bar, and I'm going to show you how to practice in a very deliberate manner these type of setups for how you identify, how you control, how you mitigate, and how you optimize, which are really the foundations of trading well. Okay, so now we're into the second part of this video where I'm going to be taking you through HNY, RTX and LYFT, which are trades that I've been in and may be in at the time of filming this video, depending on when you are watching it. So I'm going to take you through HNY, and we're going to be looking for what I call a gap down reversal bar. So remember, that's going to be a variation of a piercing pattern, a belt hold bullish, a meeting lines, a frosting, or bullish engulfing at candlesticks. But it's important to note, it's not just what happens, it's where does it happen. So let's start going through HNY. So I'm using TradingView's bar by bar replay function, and you'll see on the bottom here I've got my own relative strength line. If you search in the indicators Jack Corsellis RS line, you'll find it. I like to see a nice strong relative strength line. If it's got these blue dots, 52-week highs versus the S&P 500, even better. It's just telling me there is leadership, there is strength there, and I like to trade the strongest stocks in the market. So what do we see with HNY? Well, first and foremost, we can see a lot of relative strength, right? The RS line is powerful. There's these blue dots, good. It's showing a lot of outperformance relative to the S&P 500. We can see a powerful uptrend here as well. In terms of the moving averages, black line is the 10-day EMA, blue line 21-day EMA, the purple line is the 50-day SMA, the grey line the 100-day SMA, and the red line is the 200-day SMA. For us, in terms of this bar by bar, we're going to be looking for a sweet spot of the 21-day EMA. Certainly for precious metal miners, that's where I like it, around 21-day EMA. That's going to be a nice sweet spot. So we can see this nice uptrend here. we can see that there's some good buying coming through, wide relative candlesticks, open on the low, closing strong, good pop in the volume, open on the low, closing strong, good pop in the volume. Okay, we like that. It's also important that the stock is trending nicely above the 10-day and above the 21, okay? What I don't like to see is a stock just chopping around all over the place like this, because from a trade management standpoint, it's going to be really, really difficult. Why? Because the character of the stock is it's very choppy, it's very volatile. I just like these smooth movers like that, because oftentimes I'm going to use, okay, these key moving averages as trailing stops for all or part of the position. So what do we see with HNY? Well, we're going to start going bar by bar, but what do we see already? Okay, let's come back down to the 21. We see a shakeout demand tail, a gap down reversal bar, and then actually a trigger bar. Now I was actually targeting it through the high of this bar. I did have a trade coming through there, but I'm going to show you then another one where I then re-entered the position in a little bit. So let's start playing it through. Okay, so let's play this through. Okay, kind of going, oh, okay, reversal bar. So for me in actual trading, I had it here, I then free rolled it there, I then got knocked out circa break even on this pullback here. Okay, it's underneath the 21-day EMA. Okay, it's still kind of around there. Okay, a little bar like this, but the volume's kind of drying up. That's telling us there's not that much supply around these lows. Okay, now there's a shakeout demand tail. That's interesting. So see this shakeout demand tail? So there's a shakeout demand tail undercutting and around these lows down here. And what do you notice about the volume? There's not much volume. So yours truly was targeting a position through the high of this bar, this shakeout demand tail. And this is the thing, when you see these leading stocks basing, you can see oftentimes multiple entry opportunities. You can see trigger bars, you can see shakeout demand tails. Now I was targeting it through the high here, but I actually gapped. I like to use buy stop limit orders, try and get it within 0.5% of the prior candlestick's high. So the trigger bar, the shakeout demand tail, gap down reverse bar. So you're going to see this stock gap. So I didn't get filled in there. Okay, so the stock down gaps up here, I didn't get filled, so I just can't cancel the order. But okay, we've got this developing base. What do you notice as well with the volume? Well, the volume's really drying up here. What does that potentially tell us? There's not that much supply. And then what I'm trying to do is I'm trying to link the candlesticks back to supply and demand. Am I seeing signs that I would associate with accumulation or distribution? Well, when I start seeing a collection of these type of candlesticks around key moving averages, shakeout demand tail, I would associate that with absorption of supply accumulation. Same with the gap down reversal bar. Same with this little trigger bar coming through in here. Okay, nice reversal to the upside there. Okay, a little pop in the volume, but nothing much. And then as it pulls back down here, what do you notice? Okay, 3 red bars in a row, but the volume is below the 30-bar average in this black line. That just tells me there's not that much supply. And then you get the shakeout demand tail. If I just go and mark the low, so the shakeout demand tail undercuts the lows of the base. See how the shakeout demand tail undercuts the lows of the base. So it's not just what happened, it's not just what happens, it's where is it happening. So it's undercutting the lows. So imagine people trying to get positioned in here, in here, in here, like me, in here, okay, maybe around here. Where are they going to put their stop loss? I don't know, 21-day EMA just underneath these lows. But look at this. Shakeout demand tail just perfectly goes below there. And what do you notice about the volume? There's not much. It's around about half the 30-bar average. So what does that tell you about how many stops are being hit? How many weak hands are around? Not that many, right? Not that many. So it pops up here. So I was targeting it. I didn't get filled because of the gap there. And then it pulls back down. It's okay. Now it's pulling back down. And what do you notice about the volume? It's really just stair-stepping down here. You see that? The volume's just stair-stepping down here. Interesting, and you're starting to get potentially a developing flag, wedge, pennant, whatever you guys want to call it. But what I'm looking at here, I'm trying to read this from a supply and demand perspective as this base develops and go, that's pretty constructive. Now it's just sitting on the 10 and 21. Okay, interesting. And then, oh, what bar is this? Bullish engulfing candlestick / a belt hold bullish. And do you see where the open of that bar is? Do you guys see that? Remember in part 1 where I was taking through the belt hold bullish? Gap down, open on the low of the bar and push up. So what's that telling you about the presence of demand? What's that telling you? What's that bar telling you? The stock gap down just underneath the 1021, which is an area where I'm looking for these type of candlestick combinations. The gap down reverse bars, the shakeout demand tails, the trigger bars, right? It gaps down, opens on the low of the bar and pushes up. And it does it on low volume, low relative volume. And look at the relative strength line just ticking up here as well. Interesting, right? But the fact that it gaps down, opens on the low and pushes up tells me there's an immediate presence of demand. And it doesn't take that much buying to push the stock up, because we're just not seeing it in the volume. It tells me there's very little supply around. So when you're doing this bar by bar stuff, you're training okay, skill sets. And the main skill sets are: one, how do you identify what you deem as a high quality setup? Number two, how do you control the risk? Number three, how do you mitigate the risk? Then number four is how do you optimize the profits, which are what are the selling rules, selling guidelines that you are using to optimize profits, both in terms of monetary gain, but efficiency of the monetary gain. So now what we can do is I'm going to get the fib retracement tool here, okay? Now I don't use fib levels, I'm just using it to do this, okay? If you want to see the levels that I set, I'll do this and then explain it to you. So if you go into the settings, 0 is going to be the stop loss level. What I'm actually going to do is just delete that one there for you. So 0 is the stop loss level. Okay, 1 is going to be the entry price. I snapped it to the high and the low of the bar. 2 is going to be 1 times the initial stop loss, and 3 is going to be 2 times the initial stop loss for the free rolling targets. Okay, so then what I'm going to do is I'm going to target it through the high of this bar. So at the time of filming this video, I currently have a long position. I'm filming this on, when am I filming this? The 15th of May. So I still have a long position at the time of filming this, but the video will probably come out a couple of days later, right? So what I'm going to do is this. What I'm thinking about is, okay, I'm going to target it through the high, stop loss underneath the low. I'm going to use a buy stop limit order, and I want to get filled within 0.5% above the high of Wednesday, the 8th of May. So within 0.5% of $8.91 being the high of the bar, okay? So I have ADHD, so there's different order entry method techniques. For me, I think the two best ones are either buy stop limit orders or opening range breakouts. That's going to be very personality dependent as well. For me, with ADHD, I can be very impulsive in nature. So for me, planning and preparing my trades ahead of time while the market is closed suits my personality better. It may not suit your personality better, but again, you've got to decide on your process that suits your personality. Okay, if you find something useful here, great. Think about using it in your own trading. It's the Bruce Lee quote: absorb what is useful, reject what is useless, add what is essentially your own. So for me, I'm then practicing in a very deliberate way for how I go about trading. So I'm looking at this here thinking, yeah, okay, would like it within 0.5%, stop loss there. That's going to be a stop loss of 3.14%. You could plus 0.5% for the max stop, because I'm defining how much I'm willing to pay for any shares here, okay? And then up here, you'll see this is the 20-day ADR percentage, which is the 20-day average daily range percentage of the stock, which is 4.02%. So what does that mean? That means the average daily range of the stock, excluding gaps from the low of the day to the high of the day, is 4.02%. That is how quick the stock is. So the average daily range, how far may I expect this stock to go? 4%, 4.02%, because that's what it's done over the last 20 sessions. So that's then useful as a metric to gauge risk against and also think about risk mitigation. So what I like to do is I like to keep my initial stop losses ideally less than 20-day ADR percentages. If it's a gap down reverse bar, if it's a shakeout demand tail, potentially within 1.5 times that, but I do like to have my initial stop loss less than 4%, 5%, anything over 5%. I think I'm really pushing it. With trigger bars, oftentimes my initial stop losses you're going to see with RTX, which I think will be the next one that we'll do in terms of this bar by bar stuff. I like to have it within half to 2/3, sometimes even less, which can be really good. So what I'm doing here is I'm then thinking about the risk mitigation side of things. Now the initial controlling risk feeds into the risk mitigation. So the identify flows into the control, flows into the risk mitigation, flows into the optimizing profits, and everything is a skill set in which we can improve as traders. So what I'm then thinking here is, well, it's reasonable to expect that this stock could move 4%. Because that is a 20-day average daily range percentage of the stock. So 4% from the high of the bar would put us where? Well, 4% would put us around about here. Okay, it's not quite perfect, but it's reasonable to expect, well, the stock could go to around about $9.27. Why? Well, because that's the daily range of the stock. So what it means is if my initial stop loss is here at circa 3% and then the stock could move 4%, what it means is I could take off half the position at 1 times the stop loss, and I free rolled the position. So I've still got half the position left, effectively risk free. Now, can you get gap downs? Can you get slippages? Absolutely. Absolutely you can, okay? Because if you were to look at this, right, if I was to go here, if we were to then set this to, let's go 919 like this. So if you look at this here, okay, what we're then doing is, you see this 0.28, that's 28 cents. Okay, 0.28, that's 28 cents. So if I'm then going to set, if we assume perfect execution, okay, at $8.91, if I was to sell half of the position here, and I'd use a sell limit order to do that, so sell limit order, okay, at 28 cents gain, okay, what is then my risk on the remaining half of the shares? 28 cents. So if I sell half of the position with a gain of 28 cents per share, and then my remaining half of the position has a stop of 28 cents per share, if I was to then able to get it free rolled there, and then I get knocked out here, I'm just break even. So instead of having a losing trade, I'm just out break even. So that's then how I like to trade. And as these stocks are basing, what I like to do is try and build positions in them. Okay, and concentrate on what do I think are the real leaders. Let's just play this one forward a bar. Okay, so this one here. So if we play this forward like this, let's say we get filled up here, just on the open, okay? So at $8 at $8.96. So we'd want to adjust our stop loss up as well, or adjust this so then we can see our risk. So our risk on the trade, let's say, is 3.68%. Now what I want to do is take you through a couple of things that you can then think about in terms of your bar by bar. So what we have is we have identify, we have control, we have mitigate, and we have optimize. So let's say that your entry is here. Okay, let's say your entry is here, and let's just use, because the math is nice and easy, you bought 3,000 shares here at $8.96, okay, $8.96. What we could then do here, let me just do this like this, there we go. This is where we can think about different scenarios. So if we run through the scenario, I'm going to adjust this in a second, okay? If we run through the scenario number one is you have your 3,000 shares, you bought them at $8.96, okay? And you have a little profit on the trade, you have a profit of circa 2%, right? Let's just make this 2%, I can't get it quite, nearly 2%, okay? However, you still have open risk on the trade. In terms of the trade risk, okay, you have 3.68%. Now, in terms of total account equity risk, maybe that's 0.25%, 0.5%. Maybe you really pushed it and you're risking 0.751% of your total account equity on this position. So, okay, let's go with 0.5%. So scenario number one, this is where we run through different scenarios. So let's just put S1. You have open risk, open trade risk equals 3.68%, and you also have let's say account risk equals, let's say you risk 0.5% of your account on this one, okay, like this. So that's scenario number one. Now what we can do here, and this is why practicing in a really deliberate way, and again you're practicing in such a deliberate way in terms of how do you identify, how do you control, how do you mitigate, how do you optimize. This is in the weeds kind of stuff, right? This is trading at a high level. So that's scenario number one. What we could do though, and you have your full position, okay, like this. Now what we could do is we could create another scenario. So let's just move this across here. We could create another scenario. So what we could do is we could go scenario number two. Now watch this, ready? If we were to move your stop loss up, watch what happens to these free roll targets. So remember, the purple line is going to be 1 times the stop loss. That could be initial stop loss, or it could be your new stop loss. When I'm thinking about risk mitigation, I'm just thinking about when is it prudent to do so. I don't care about free rolling off initial stop loss. The market doesn't care where I bought the stock, only I care where I bought the stock. How do I want to manage the position? I want to remove the risk. Sun Tzu, Art of War principle. Okay, position myself beyond the possibility of defeat, and then I would add when I think is prudent to do so. So what I could do here, right, is you see the black line and the blue line, 10-day, 21-day EMA. Well, can I push my stop loss up and keep it underneath there? Can I keep it underneath there? Well, it's going to be pretty close. Okay, well, I could get it to there, which is then underneath the 10-day EMA. So what I could do in this instance, I could move my stop loss up. So this is then another scenario. What I could do is I could move my stop loss up. Just going to remove that a second. I could move my stop loss up from $8.63 to $8.97. Now, why would I want to do that? Well, what it means is what I could do here is I could then sell half, which equals 1,500 shares, like this. So if I were to sell half of this hypothetical position, I sell half of the position 1,500 shares. Now, what that means is if we go through scenario number two, is open trade risk equals 0%. Now, can you get gap downs? Can you get slippages? Absolutely, you can. Okay, 0, 0 like this, and then our account risk is going to be 0%, like this. And then we have half position. So you then have to decide for yourself. This is why you practice things in such a deliberate manner. Like there's no real guesswork here. Do you see what I mean? Like everything is thought out. Everything is thorough. You're really trying to think through everything and go, okay, how am I going to manage this position? What am I doing to identify? What am I doing to control? What am I doing to mitigate? We're flowing through the phases, the components of a trade. First, we start with identify. Then we start with control. Then we start with, or then we go into risk mitigation. And then once we've mitigated the risk, then I start thinking about, okay, what are the selling rules, selling guidelines that I'm going to use to optimize the profits? So this, at this point here, as the trade starts to get out and you start to have a profit, doors open. How do you want to manage the position? Do you want to take a third off? You could take a third off at 2 times your initial stop loss or your new stop loss. In this instance here, you'd have to push it up, maybe go lower the day. So what you could do here, watch this, ready? Go lower the day and just place your stop loss there just above the 10. You could then take a third off. So take 1,000 shares off, move your stop loss to $8.88 like that. So from $8.63 to $8.88, sell 1,000 shares there, then you've still got 2,000 shares hypothetically risk-free. Can you get gap downs? Can you get slippages? Absolutely. Is it prudent to be that tight with your stop loss? You may reach a different conclusion to me, and that's absolutely fine. But realize as the trade starts to get out, you have different oars, you have different doors. How do you want to manage the position? Do you want to do this? Do you want to do that? And if you understand the inputs that you're putting in and realize it's a skill set, okay, mitigating risk is a skill set. How do I want to mitigate the risk? How do I want to get the risk out? Now you may just go, I just like scenario number 1. I don't mind having open trade risk of 3.68%. I don't mind still having open account risk of 0.5%, and I've got my full position. Or you may go, actually, I prefer scenario number 2 here. So imagine this is a couple minutes to the close. You see, okay, yeah, price is going to close around $9.13-ish. Well, what I actually want to do here is I want to mitigate the risk. So now I've got open trade risk, hypothetically 0%. Can you get the gap downs? Can you get slippages? Absolutely can, okay? My account risk is now 0.0%. Why? Because if I now get knocked out here, so if I now get knocked out at $8.79, I haven't lost anything. I'm just break even. I'm break even on the trade and break even in terms of account risk. And I've got half my position. I'd rather be there. That's my, as a punch of my friend, that's me. I'd rather be there. That's me. I like getting the risk out, and then what I'm trying to do is sit and nail that. So then it goes in, okay, what are the selling rules, selling guidelines to then optimize the profits? Now you could have an idea of, yeah, I'm going to use 10-day, 21-day as trailing stops, maybe a little bit back for the 50, but actually if it gets short-term extended, I may choke off part of the position by going lower the day, lower the day, lower the day with all or part of your position. So maybe you do it with a couple of hundred shares, a couple of thousand shares, depends how much you have, your position size as well. So everything there is then a skill set, but the character of the stock also in that final part of the trade, optimizing profits, the character of the stock dictates a lot in terms of how I'm going to manage the position. What do I think is going to be optimal to optimize profits based on the character of the stock and how it wants to trend, how it moves from point A to point B. That makes sense? So hopefully that there is giving you a really good flavor for how I think about managing positions. That's then the final bar there. And then potentially it kind of pops, tests, and then maybe it sets and gives another opportunity. Maybe it goes and puts in like, in here, it didn't on that bar there, but maybe it goes and puts in like a really nice trigger bar. Maybe you get a bar like this, just sitting on the 10 or the 21 or a shakeout demand tail. Then I can add to the position. Then I can raise my stop loss up as well. So I can then raise the stop loss on the remaining half of the shares. In this example, 1,500 shares. Okay, can I then raise my stop loss up? Can I then add, can I pyramid, can I really kind of push the position if I really like it from a technical standpoint, fundamental standpoint, the liquidity's there, really strong stock, good ADR on it as well. Can I push it? So what we'll do in the next one is we'll go bar by bar with RTX. Okay, so we got RTX loaded and I'm going to go bar by bar till we identify the perfect trigger bar that I targeted. So we can see that the stock is in a nice uptrend and it's currently building a bit of a Davis box. If you know what the index is, the Qs and the SPYs were doing around this time, they were just falling out of bed. This stock is displaying a tremendous amount of relative strength, just holding around its 10-day, 21-day EMA. It's okay, earnings, we get kind of a doji, but then what do we get? We get a shakeout demand tail, quasi nearly an inside bar, another shakeout demand tail, the volume's drying up, RS is good. As I said, the indexes were just rolling out of bed below 50 days and things like that. So this stock here displaying relative strength. So let's just play this. Let's play this forward, okay? So we'll play this forward, okay, kind of pulling back down. Okay, not a bad bar in there. Okay, there's a nice shakeout demand tail there, undercut some lows, kind of bounces off the 21-day EMA. Ooh, then that bar there. That is a textbook trigger bar. In the context of a Davis box, sitting around one or more key moving average, being the 10-day EMA, the black line. So see the tightness in price. So now we're going to get into supply and demand of these bars. See the tightness in price, see the very low volume. Volume is circa a third versus the 30-bar average being the black line. What does that tell you about selling, about supply? There is hardly any of it. Hardly any of it. So this is the Minervini point. Volatility, contraction. Volatility tends to contract. It's the Toby Crabell point of the market in stocks tend to move from periods of contraction to expansion. So this is extreme contraction. So then I'm expecting the expansion. So I then want to be playing the expansion. So let's just zoom into this, okay? Because trigger bars can create very, very asymmetric risk versus reward trades. So this one I took at the time of filming this on Wednesday the 15th. Still have a position in this stock, okay? So what we can now do, okay, is I'm targeting it through the high, stop underneath the low. For me, I like using buy stop limit orders, limit invariably 0.5% above the high of the trigger bar, the shakeout demand total gap down reverse bar, okay? So if we just go, okay, it's a fairly liquid stock. I think 50-day average dollar volume on this stock at the time was around 700 million, something like that. It's fairly good, maybe 600, 700 million. So if I'm targeting it through the high, stop underneath the low, my initial stop loss is going to be 0.43%. 0.43%. Any of you who've been trading longer than 2 weeks will know that is a ridiculously tight stop loss if you're swing trading off the daily charts. Now, relative to the 20-day ADR percentage, so the average daily range of the stock is not the quickest of things. It's 1.52%, but the initial stop loss is circa one third versus the 20-day ADR percentage. 1/3. That's really, really tight indeed. Okay, now I'm using a buy stop limit order, so my initial stop loss is going to be a little bit more. From memory, it's 0.67% where I then got filled. So obviously here we're assuming perfect execution. You want to make it a little bit harder on yourself, just pull it up a little bit, maybe 0.5%. So then you're assuming you always get filled at your limit in terms of your buy stop limit. But a reason that I like using the buy stop limit is I'm defining my maximum risk. Why? Because I'm defining the maximum amount that I'm willing to pay for any shares that is 0.5% above the high of that trigger bar. Okay, so let's play this bar forward, right? So this one here, now how far does the stock go? Well, if we just look from the prior day's high to here, the stock goes 1.16%. It doesn't go up 10%. It doesn't go up 15%. But the character of the stock is, it's not going to do that. The 20-day ADR percentage is 1.5%. But given the fact that the initial stop loss was so tight relative to the 20-day average daily range percentage, that was reasonable to expect. The stock could get out 2 times the initial stop loss. We only had to go circa 1% or so, which it did. So let's just say here, right, the close. So let's say you buy circa 3,000 shares, right, because the math is nice and easy. Okay, your entry, you buy 3,000 shares at, let's assume you got filled on the open, right? I'm just going to pull this up a little bit. Let's assume that you got filled here. Okay, and now what we're going to do, I'm going to talk to you a little bit about developing a Bayesian mentality. So let's say that you get filled at 102.20 like this, okay? Then let's just adjust this up, 102.20 like this, okay? Because this is where we're really working in terms of your skill set as well. So let's say you buy your 3,000 shares at 102.20, okay? Should make sure the camera is still working. Looks to still be working. Unfortunately, you have to look at me a little bit. Here we go. So 0.57%, that's our initial risk. Okay, so we've got our 3,000 shares, and let's say that you were planning on taking off 1/3 of your position at 2 times your initial stop loss. Okay, 1/3 of your position at 2 times your initial stop loss. Well, to do that, what we would have needed, okay, we could have done a sell limit order here at this green line for 1,000 shares. 103.38, because you were like, I'm just gonna take off 1/3 of the position, 1,000 shares at 2 times my initial stop loss. So I still keep 2/3 of the position back in this instance here to around 2,000 shares. Okay, so towards the close, let's imagine that there's 5 minutes to go, and it looks like, yeah, stock's going to close strong. This is the price. Imagine there are 5 minutes to go. So this is where we start thinking about your skill set and training that skill set as a trader. Okay, great. You've been able to identify a really good setup. You controlled the risk. You created a very asymmetric in nature risk to reward trading opportunity. Now we're into the risk mitigation. What are you going to do? So if we go through the scenarios here, okay. So let's say S1, okay. Scenario number 1, you have open trade risk of, that's pretty tight here, isn't it? 5.7, 0.57%. Let's say you have account risk is equal to 0.5%. Okay, you could have gone pretty big here in terms of how much of your account you wanted to put in this thing, because it's pretty liquid stock and the initial stop loss is so tight. But you may have a max in terms of, I don't like to have more than say 20%, 25% of my account in any one stock, because things can happen, anything can happen in the market. And you have your full position. That's scenario number 1, right? If you're full position, you've got a gain on the trade of, let's say, around about 1% or something like that. Yeah, okay, interesting. If we now go, I don't know where that's just gone. That's just disappeared. Let me try and write it again. Let me pull that back. Oh, add text. I've got to do it again. Sorry, guys. Here we go. Right. So S1, bear with me a second. So what we said is we had your open trade risk is equal to 0.59%. Your account risk is equal to, let's say, 0.5%, and you have a full position. Okay, now what we could do is we could go and develop scenario number 2. So open trade risk, I'm going to show you how we do this. So you could have open trade risk of 0%. Let's do this. Open trade risk equals 0.00%. I'm trying to line it up, that's my OCD. Let's say we get your account risk down to 0%, like this, and let's say you have 2/3 of your position. Would that be quite interesting? If we could get you to scenario number 2, where you have your open trade risk hypothetically of 0%, your total account risk on this trade is 0%, because we free rolled the trade. Can you get gap downs? Can you get slippage? Absolutely. And you still have 2/3 of the position. So you then still have 2,000 shares risk free. You break even. Does that sound interesting? Should we do that? Let me show you how to do that. So all we have to do here, let's say there's a couple of minutes to the close, right? All we have to do, let me just close that. All we have to do now is just push your stop loss up. Watch, bring that green line down. Ready? There, like that. So what we've done is, it may seem insignificant, but it's really, really, really significant. Okay, let's just do this. As I said, it may seem insignificant, but it's really, really, really significant. Okay, watch this. Bring this down. What we've been able to do now is we sell 1,000 shares right there. A couple minutes towards the close, like, okay, we'll take it off there. So what we've been able to do is, just by moving your stop loss from 101.62, we've moved your stop loss 8 cents. Think about this. We have moved your stop loss 8 cents. From 101.62, from there to there, you can't even see the arrow. We've moved it 8 cents, but by adjusting your stop loss 8 cents, what were we able to achieve? Well, your open trade risk has now gone from 0.57% to 0%. Now, can you get a big gap down like this, where the stock gaps down and it opens here? Yeah, you could, but you wouldn't have been knocked out anyway, and an even bigger risk. So this is the risk mitigation side of things. Your account risk, okay, you're now not risking 0.5%, you're now risking 0%, because we've been able to free roll, and you don't have your whole position, but you have 2/3 of your position. If you bought 3,000 shares here, you still got 2,000 shares, hypothetically risk-free. You'll break even. Now it's a case of go gadget. Can this thing go? So it seems insignificant, right? You moved your stop loss 8 cents, but 8 cents was able to achieve this. This is what I mean. It's a skill set. It's really, really, really deliberate. And the great thing about technology and bar-by-bar replay functions, you can practice this, and you can really work on your skill set of, how do I identify a setup? How do I control the risk? How do I mitigate the risk? How do I optimize the profits? You can work on all of this, like, really deliberately. So then we play it forward. Okay, great, it's getting out, supply shoot. Maybe you want to kind of choke it off, maybe you don't, maybe you want to sit for a bigger move. But what you're able to do in the first day is go, right, yeah, free roll it. And now it's a case of, okay, what do you want to do? Do you want to start taking little pieces off there? Do you want to try and sit, let a trend play out? How do you want to manage it? How do you want to optimize? What do you think is best? Okay, it's a relatively slow stock. Are there potentially a lot of quicker stocks setting up? So you want to kind of be taking capital from this position and go put it into, oh, it looks like Nvidia's setting up, looks like Broadcom's setting up, looks like ABC, XYZ are setting up. Do you want to then potentially transition over there? Is that a good decision? It's not a good decision. Okay, we can review that. Understand the decisions you were making and why you were making them. Everything is thorough, everything is thought out. So now we'll go into the last one, which is LYFT. Okay, so now we're going to go with LYFT, and I'm going to show you a shakeout demand tail. So what do we see? What do we see with LYFT? Well, we see it comes out of a decent sized base here. Look at the volume coming through. Huge volume, big uptick in the relative strength. This is a really good reaction. Like, this looks like institutions want a shed ton of it. They want a shed ton of it, right? But are we going to be chasing up there? Are we going to be chasing up there? No. What I want, you guys see this bar? Shakeout demand tail? Look at that. Off the 10-day. Okay, good reference point here, isn't it, already? The stock seems to like a shakeout demand tail off the 20-day. Sorry, off the 10-day EMA. Big base as well. Okay, interesting. Okay, I'm not going to be chasing it up here. I'm not going to chase up here. I'll watch. I'll wait. Wait for the pullback. Okay, pulling back. Pulling back. Pulling back. Okay, that's more of a doji rather than a shakeout demand tail into the prior base high. Okay. Okay. Okay, kind of pop in. Not there yet. Okay, reversal. Oh. Oh. Now what bar do we get? So it's pulling into the prior base high. So the previous ceiling becomes the floor, potentially. We've just had mega volume coming through on that earnings reaction. And then we get a shakeout demand tail around the 10, and we have a reference point that the stock likes a shakeout demand tail around the 10-day after 10-day EMA after a nice move, and then it pulls back in. Look how the volume dries up. Look how the volume dries up. Look at the improvement in the relative strength line. Interesting. Now, good ADR on this one. Quick stock. 6.68%. Let's go think about it. Through the high, stop under the low, work out the initial risk. 36%, assuming perfect execution, you could plus 0.5% to that. So, okay, 4% off an ADR of 6.5%, it's around about 2/3, like the metric there. Then we could be thinking about, okay, how do we want to free roll? Do we want to go 1 times? Do we want to go 2 times? Do we want to push the stop loss up? So I'll be quicker on this one, right? I'd really encourage you guys to go and do this. But then as the stock starts playing, oh, okay, shake out demand tail. Could I add to the position there? Can I add? Can I be aggressive? Can I try and add to these things? Okay, there maybe got knocked out. Okay, kind of more shakeout demand tails. Could I be looking to add there? Can I push it? Okay, here, could this then turn out to be a cup and handle type pattern like this? So what I'd really encourage you to do is realize that trading is a skill set, and the skill set is focused in 4 main areas. How do you identify a high quality setup? How do you control the risk? How do you mitigate the risk? How do you optimize the profits? If I were to ask you the question, how do you, and this is the emphasis on you, how do you identify a high quality setup? What are your criteria? How do you control the risk? How do you define that? How do you control the risk to create what you think are asymmetric risk versus trading opportunities? Do you use a stop loss? If you don't use a stop loss, why are you not using a stop loss? How do you mitigate the risk? How do you position yourself beyond the possibility of defeat? How do you remove the risk and then sit and let the trend play out, which then moves into the final part? What are the selling rules, selling guidelines that you are using to optimize profits, both in terms of monetary gain, but efficiency of the monetary gain? How do you adapt? You may have had a great idea that I'm going to use a 10-day, 21-day key and be keeping some back for the 50. But what happens if this happens and the stock on a short-term basis is really extended? Do you go lower the day like that when it's extended from the 10-day and choke off all or part of the position? Are you adaptable enough to do that? Adapt to new information. If you do that, why did you do that? Was it a good decision to do that? In that instance, yeah, probably pretty good decision. Stock short term is extended. But as Davis would say, let your stop loss decide. So there are so many facets to trading. There are so many ways to improve at trading within those 4 main components: identify, control, mitigate, and optimize, which is what I really try and focus on helping you guys with on this channel. So thank you very much for watching. If you made it all the way to the end of this video, thank you very much for the support on the channel, and I look forward to seeing you in a future video.